Pillar 2 and the Globe rules usher in a new era in global tax compliance. In the evolving international tax environment, a recent global development has caused turmoil among multinational taxpayers. The OECD's Pillar 2 initiative, also known as BEPS 2.0, has introduced new tax compliance rules for multinational enterprises. Pillar 2 introduces the Global Anti-Base Erosion or GLOBE rules, designed to ensure that large multinationals are subject to a global minimum tax rate of 15%, preventing profit shifting to low-tax jurisdictions. Only multinational groups with annual consolidated revenues of €750 million or more are subject to these rules. The goal of Pillar 2 is to curb tax competition and ensure a level playing field. Many jurisdictions have adopted the GLOBE rules, but not all. Notably, the United States has not yet implemented Pillar 2. However, there could be significant developments in the near future, as the 2024 election has ushered in a new unified government with a clear mandate to implement its agenda. While this may hint to the possible direction of new tax policy, uncertainty regarding its practical implementation remains an important factor. Pillar 2 has two primary mechanisms: the income inclusion rule, which requires the ultimate parent entity to pay a top-up tax on subsidiaries in jurisdictions where the effective tax rate is below 15%. It ensures that every jurisdiction where the group operates meets the minimum tax requirement. The undertaxed payment rule, which applies when the IIR does not capture certain low-tax payments by denying deductions or imposing additional taxation on transactions with entities that fall below the 15% threshold. Meeting the compliance requirements of GLOBE is no easy task. The information needed to calculate top-up taxes is significantly more burdensome and time-consuming than previous reporting obligations. Multinational groups must provide detailed data across jurisdictions, making this process far more complex. Additionally to applying the GLOBE rules, jurisdictions can impose a qualified domestic minimum top-up tax on the resident entities, ensuring they meet the 15% minimum tax locally, which prevents other countries from applying the IIR or UTPR. This allows nations to top up the taxes of domestic entities, retaining tax revenue within their own borders. As the GLOBE rules evolve, multinationals must reassess their tax structures to comply with new global standards, mitigate risks, and align with the new tax landscape. Adapting to the GLOBE rules will be crucial for long-term success in the international tax environment. Contact our experts for a confidential consultation today.